Hello, we'd like to welcome you guys to this session. My name is Sarah Edgar, and on behalf of the World Trade Center World Trade Center Utah, the Center for National Security Studies here at Utah Valley University, the Herbert Institute of Public Policy, and Strider, we'd like to welcome you to this afternoon's panel, China's Domestic Economy and Global Disruption. I'm pleased to introduce Seth Sunderland, who is currently CEO of Spring Canyon Capital. And prior to that, he was an investment banker for 16 years at U.S Investment Bank, heading mergers and acquisitions in Southeast Asia, located out of Hong Kong. And he will be our discussion leader today. So please join us in welcoming Seth Sunderland and our panelists.
Thank you, Sarah, and welcome to everyone here. This is always one of the tougher panels right after lunch, so I hope everybody is heavily caffeinated right now. But I actually think the content and the discussion should speak for itself and keep everybody interested and focused. We're excited to have some of the foremost China experts here with us today on the not only from a macroeconomic standpoint, but also from a business perspective and what's going on the ground there with the businesses, both foreign and domestic, in China. And so the purpose of this panel right now is to dig a little bit deeper on some of the themes that we covered in this summit. And so we'll be taking a deep dive on a few themes, but hopefully you come away with a perspective in terms of what the long-range prospects are for the China economy. And there's probably no more important strategic aspect in terms of our relationship with China than understanding what the long-term growth prospects are for the China economy, because that will dictate how we deal with the challenges that China presents and the disruption that comes along with that. The other aspect that we're going to take a look at is taking a deeper dive into how China's economy is unique, and then some of the specific challenges and strengths that they have within that economy. So without further ado, let me introduce the rest of our panel here. And so first to my left here, we have Nicholas Lardy. So he is the Senior Fellow at the Peterson Institute for International Economics. He is a top expert on the Chinese economy. He's published numerous books, including his most recent book on Chinese SOEs, which we're going to delve into a little bit deeper because it's an interesting topic. And it was a very well named, I have to say, I like the name, The State Strikes Back, End of Economic Reform in China. So well done.
Question mark at the end.
Question mark on the end. And I'm sure he'll be covering that question mark. So we're excited to have Nick here. We also are joined by Zoe Liu, who's the Fellow for International Political Economy at the Council of Foreign Relations. She was an instructional professor at Texas A&M Bush School of Public Policy based in Washington, D.C. So we're excited to have you here. And then we are also joined by Tim Stratford, who's the managing partner at Covington and Burling LLP, former assistant U.S. trade representative, and advises U.S. companies doing business in China. So he'll have an on-the-ground perspective in terms of what's going on in China right now, whether it comes to COVID, whether it comes to some of these different regulation and government control aspects that we're seeing more out of. So let's give a quick round of applause for everybody here. And this was touched on a little bit earlier in the summit, but we're going to take a deeper dive into this. And so, Nick, can you maybe walk us through in a little bit more detail, what are some of the main differences in the Chinese economy versus the U.S. economy, including what the state's role and the party role is in relationship to private enterprise?
Right. Well, the Chinese economy is a complex mashup of state companies and a big private sector. The state companies tend to be quite large. They dominate certain sectors: power generation, oil and gas, transportation, airlines, rail, etc. And as somebody said this morning, there are only about 100 of centrally managed state-owned companies. Now, there are more than that because many of these companies have 3, 4, 5 levels of subsidiaries, so that the number of firms would be greater. But there are 20 million private companies. So the private sector produces, as we heard this morning, maybe 60, 70% of GDP, and they operate in markets that are largely competitive. Prices are flexible. You know, China has price controls on electricity. Surprise, surprise, I think I've heard of that before. Pharmaceuticals, which is common in Europe, and a few other things. But most things, the prices are determined by supply and demand. So it's predominantly a market economy with private firms, which have big state companies, and then you have a very large government role, as we've heard, in terms of industrial policy, establishing priorities. And once they've established priorities, they are prepared to subsidize not just SOEs, but in some cases, private companies. And I think the semiconductor space is probably the best example. Almost all the semiconductor firms in China are private, but they've been given, you know, the state makes equity investments and gives them loans, and so, you know, their ownership structure is, shall we say, evolving. So they may technically still be private because private equity may own most of the company, but there's a state involvement. So when the state establishes priorities, they tend to move fairly strongly. I would say, however, that what we heard, well, I want to talk about one other thing not related to that book, and that is, I think in some of the panels we've heard this morning, we have tended to overstate the role or the influence of the United States. We heard the phrase the other day that the United States is financing its own demise by investing in China. Foreign investment in China is very important, but all foreign direct investment in China is equal now to a little bit less than 2% of GDP. If you take all the financial flows from the United States, that is direct investment by multinationals, equity raising on the New York Stock Exchange and NASDAQ, bond purchases by institutional investors and so forth, it's probably something in the neighborhood of 1% to 2%. So I think we shouldn't overestimate the extent to which we can change the trajectory of China. As we heard this morning, they have many challenges, but I think some people in the back of their minds are thinking that, well, if we just get a little tougher on China, they'll slow down and we'll be able to keep up. Keep in mind, China has grown faster for longer than any other country ever. And I think it's mostly a result of the reforms that they undertook. Damien commented on those in their own efforts. Certainly they've benefited from interacting with foreign firms, from trading and so forth, but I think the results speak for themselves.
Thanks. One follow-up question I have on that is related to state enterprises, and then maybe we can jump over to private enterprise. But there has been, since Xi Jinping took over, there has been a change in approach in terms of SOEs, what they're doing to prop them up in terms of financing. And why SOEs are a small part in terms of the sheer numbers, they do make up 20 to 25% of the overall economy and 40% of the assets. And so can you just talk about what's happened structurally with SOEs, and why are they pursuing a policy to prop those SOEs up and support them more over the last 5 to 10 years?
Well, the main thing that's happened really since roughly the time Xi Jinping came to power 9 or 10 years ago is that the private sector has had less access to bank credit. Banks are lending more to state companies as a share of their total loan portfolio than they had in the previous 10-year period. But private companies have still been able to grow fairly rapidly, even though they have had difficulties getting access to credit from the banking system. And the explanation is very simple. Private companies are far more efficient if you measure it in terms of return on assets in the industrial sector. Private companies earn returns that are about 3 times that of state companies. So they don't need so much bank lending or raising funds on capital markets in order to expand. And indeed, that's why they're growing rapidly. They reinvest their profits. I'm guilty of spending a lot of time trying to figure out what's going on in the banking sector. One of my earlier books was on that. But the thing you have to keep in mind is even though they have a big state-dominated financial sector, state-owned sector, about 75 to 80% of all investment in China is financed with retained earnings. So if you have returns that are 3 times your state competitors, you obviously, if you want to, you can reinvest part of those earnings and continue to grow your business, even though if you went to the local bank and asked for a loan, they might turn you down. So the successful private companies are still expanding. I think the share of GDP produced by the private sector continues to, it's not shooting up, but it's inching up bit by bit. So it was 60% a few years ago, now it's 70%. You know, in 5 more years, it'll be 73% unless something changes. So the big thing that changed when Xi Jinping came in is he kept talking about state companies need to be bigger. So they've done a lot of mergers of state companies. They've given them better access to credit, but their performance has not improved. If anything, it's gone down in terms of the standard metrics like return on equity, return on assets, and so forth. So you have a very large private sector that tends to be more efficient and a somewhat smaller state sector with low efficiency, heavy dependence on financing from state banks.
So with the SOC, I mean, it's probably fair to say that the SOE sector is a drag on growth.
Absolutely.
Because of the returns there. Why is the state propping them up? Why are they not privatizing more and moving towards? Because it was a big issue for WTO admittance is to start to move away from that SOE driven economy, and that's where we sometimes run into some of these issues and just how to deal with those types
well,
of
as Damien pointed out this morning, they did shrink the state sector quite a bit back 20 years ago, but it's still fairly large, particularly in some of the sectors that I mentioned. Now, why do they not, privatize more? Well, first of all, some of these state-dominated sectors are typically sectors in which the state exercises control or is the owner in many other countries, like the rail system, the national airlines, electric power generation and distribution in many market economies is either directly owned by the state or very heavily regulated. The electric company may be private, but if they want to raise rates, they have to go through a regulatory process to get approved. But there are a lot of other sectors in which state firms also dominate, which are not typically the case in other market economies. They still have a very large role in steel, certain parts of the machinery and equipment sector. Now, why do they keep that? Well, I think what was touched on this morning, I think Xi Jinping thinks that having a big state sector is an important element of control. And as we heard earlier, Xi Jinping is nothing if not for control. He wants to be in charge of all the bodies that make decisions on policy, whether it's foreign affairs, domestic economy, military. They have all these so-called these small leading groups, and he's become the chairman of all of them. So all the power comes to the top, and I think he has the view, we'd have to, I assume, based on what we see, that he thinks having a still significant state-owned sector gives him more control. And I think he probably, but I'm not sure, he may recognize that he's paying a price in terms of economic growth. There's a misallocation of capital to keep these companies going, but he's willing to pay something in order to have that control.
Thank you, very insightful. And I think that's one that we're going to explore a little bit. Where on the spectrum is China in terms of state-directed economy versus a market economy? They have this SOE sector, but with a private sector that's getting a higher return on assets, it's grown. And they have several large companies. But I think what we're going to see here is a theme of control that's been present over the last few years. And Zoe and Tim, maybe if you would like to talk about the private sector in China and just how the regulatory environment has changed over the last even 5 or 6 years, and if you want to take a longer perspective over the last 10 years. Zoe, do you want to take it first and then Tim?
Sure, I will just take the first stab at this. But before I start, I just wanted to express my gratitude to be here. It's really an honor to be invited to be here at Salt Lake City at the University of UVU, I'm practicing it, right? UVU. And I learned a lot about the history of the university, and I'm extremely proud that the university here actually is trying to embrace, a very core message that a lot of higher education is trying to embrace, which is diversity, equity, and inclusion. And I have a tremendous amount of admiration for our university here. So, just to quickly go back to the point with regard to regulatory changes and the private sector, I wanted to echo one point which Nick already raised, which is the dominance of the state in certain sectors. And these certain sectors simply means China has special ways to define its terminologies, right? So there is this one thing that China considers as very important, which is the so-called the strategic sectors that are essential for national security. And national security, by definition, actually include financial security. And that's nothing, recent. Since the Asian financial crisis, that was the very first time when you see a lot of Chinese policymakers started to fully embrace the idea of financial security. And now you really do see President Xi written that into his whole comprehensive definition of the comprehensive concept of national security with his own interpretation, right? Now, what does this mean? When you look at how China's perspective of strategic sectors have shifted, used to be coal, steel, cement, power generation, but now, if the government started to realize, actually, the new economic generators are coming from probably, let's say, digital economy, probably, let's say, platform economies like, Meituan, Didi, and this WeChat, these kind of things, you probably realize, well, probably there is going to be a regulatory shift towards this strategically important sector. And then on the other hand, I would totally agree with Nick's point with regard to, the importance of financial sector and the state dominance in that. And just think about it. 4 major Chinese commercial banks, they are state-owned, but that does not necessarily mean the state-owned 100%. Right? If you look at it, there is this institution called Central Huijin, and they are the so-called the financial aspect of SASAC. SASAC controls all these major SOEs, whereas the Central Huijin, it controls major China financial, systematically important financial institutions, and that includes 4 SOEs, 4 commercial banks, and they also include major Chinese insurance companies. They also include China's policy banks, and including this one important agency that very oftentimes being neglected, which is the so-called, export credit insurance company, which is actually actively involved in almost every single BRI project. So just, the landscape of control, I would say it could shift across time, but that does not necessarily mean the state controls everything. It's an important stakeholder, but, where the stakes is important, it's shifted over time, if that makes sense.
Tim? Sure. I'm also delighted to be able to travel all the way to UVU from my house in Provo, which is 5.2 miles away. But actually, I split my time between Utah and Beijing, where I continue to manage my firm's office. This month, in fact, is the 40th anniversary of my wife and children and I moving to Beijing, and we've been in China someplace ever since that time, except for 5 years when I was in Washington at U.S. Trade Representative's office. So the perspective I have is from when China first started to open up and allowed foreign investment to where we are today. And we've seen quite an evolution. China originally was the state-planned economy, and gradually over the 40 years, we saw China reform and open up and create far more opportunities for foreign companies to invest in China. At first, we were only allowed to set up joint ventures, but then gradually they allowed us to have wholly owned enterprises. And so we've seen quite dramatic changes in China. And now we're seeing, often we see cycles back and forth, but right now I think we're seeing a cycle that's more of a 40-year pendulum. And now we're seeing China move in a number of ways in a different direction than what they were moving when I first moved there with my family. Zhao Ziyang, who was the party secretary when I first moved there, was focused on separating the party from government and from enterprises to let them operate more autonomously, and then the general overall policy framework would be made by the party. But now Xi Jinping is very much involved in putting the party back into the details of things, and it comes back to what we've been talking about with respect to control. So how does this affect us as people who are trying to do business in China? I think the important question is not what is the state sector and what is the private sector. When I worked for General Motors, we had a joint venture with a state-owned enterprise, and it was a very successful joint venture, and whether they were state-owned or privately owned really wasn't material, although what was more important was trying to understand what is the government's overall policy with respect to the auto industry. And that's the most important thing I think we need to be looking at. No matter whether you're dealing with a private company or a state-owned enterprise, what are the goals of the Chinese government with respect to that particular industry? And what we've seen is that in some industries, China has been intent on developing their own expertise and their own strong national industries. That's understandable. So what we've seen is in some industries, you first go in as a foreign investor, you gradually figure out how to do things, you build the whole ecosystem for your particular industry, and then as local competitors learn how to do things, benefiting from the contribution you made, local competitors arise, and then you find yourself in a very different competitive position. And policies may change that will help the local competitors go against you. So what I would say is the most important thing is to find out what are the Chinese policies with respect to your particular industry and your particular place in the value chain, because that will have a lot of impact on the sort of policies that they may use to support what you're doing, or maybe to support your competitors domestically. I'll just add that in my firm, we've tried to study this for various industries, and we came up with a kind of a taxonomy of 130 different industrial policy tools that the government may use to help a foreign invested company or a domestic invested company in a lot of different ways. And so that's what I would encourage you to do, is as you look at the China market, understand what the policies are for your specific industry.
Thanks, Tim. I think that's really insightful. And just by way of education for some of you that are new to China, I think people that have had experience in this probably know. But I'm glad you said it's not just state-owned businesses and private sector. There's a spectrum on that too. And so there's a lot of individual state-owned investment funds that invest in strategic areas, right? And these funds exist in other countries as well. I think they're larger in scope in China. And so you'll have companies that have significant investments from these state-owned enterprises themselves or state-owned funds that are investing in them. They'll be getting loans and capital from a banking sector that's primarily state-owned. And so what the industrial policy is, as Tim said, has a direct impact on what happens with the state. And interestingly, in private companies, it was alluded to earlier in the session, or earlier in the summit, is every single private company by law is required to have a party unit within the company. And so this is a Communist Party unit that's going to play a role. Historically, they were pretty innocuous. They did not play a big role in management decisions or things like that. That's changed a little bit over time. And I was just curious, Tim, in your experience there on the ground, have you seen a change over the last 10 years in terms of how they're participating and interacting with companies?
The local party organizations are sometimes putting more pressure on companies to have party committees in their organization, but it's not uniform. And for the most part, they try to be helpful. They don't try to interfere in the business that much, and they actually might help you to solve problems because of the networks that they have. So by and large, the party organization in foreign invested enterprises has not really been a problem. Some people are concerned that maybe it'll all be set up and then later on they'll be used as a tool to sort of exert more control. And you certainly can't rule that out, with political changes that take place. But so far, it hasn't really been a problem.
Right, and I think we are on, I think for foreign entities, absolutely. For domestically owned entities, it seems like maybe there has been a little bit uptick just from clients and former
definitely the
colleagues.
Case for domestic enterprises. They've been playing a much more empowered role in
so including changing, like urging changes in your corporate charter, bylaws to memorialize a role for the Communist Party Committee within that. And so I think when that goes back to where on China are they on the spectrum on state-directed versus market economy, and it varies over time, and I think that was well put. And we're on the pendulum, they're swinging back towards more control. And Nick, maybe you'd like to comment in terms of how does that impact your long-term growth prospects when the state starts exerting more control, and the price for that control is maybe that the state is the one directing the capital flows more aggressively than they had before. And what type of impact does that have on your economy and innovation?
Well, I can tell you my kind of framework for looking at this question of, what's China's long-term potential growth? And I think one has to start by looking at the potential for convergence. And we've heard several estimates this morning or statements about when China is going to overtake the United States in terms of the size of its GDP. But what really matters is per capita GDP. And per capita GDP in China, measured in purchasing power parity, is about 25% of the US level. Well, they've got 1.4 billion people, so they can be closing in on us in terms of absolute size. But the idea of convergence is you can learn from abroad, you can borrow technology, you can license technology. It's a catch-up, and we've seen it over and over again, particularly in East Asia, in the case of Japan, Korea, Taiwan. So I think China has the potential to continue to grow relatively rapidly. That doesn't mean the 9 to 10% that they've had up until a few years ago. But if you look at the experience of the countries that I just mentioned, their high growth periods didn't come to an end until they got up to about 55, 60, or 65% of the then current US level. So there's a potential for China to continue to grow very fast, 6, 7% maybe. But offsetting that, as you point out, Seth, that assumes that you've got the right policies in place to capture the convergence potential. And if you're misallocating capital and keeping a lot of state-owned enterprises afloat by pouring resources into them, that means the more productive part of the economy is going to be starved for resources, and you won't reach the potential. So that's the way I look at things. Potentially, China could grow at 6, 7%, maybe for another 20 years. But they may never capture that because the state is intervening too much, misallocating capital, trying to maintain or expand political control. The one optimistic thing I would like to say, and this goes back to a comment that was made this morning, is that private entrepreneurs are fleeing China. I think this is a complete misnomer. I don't see any evidence whatsoever for that. This regulatory crackdown that Seth was alluding to was focused on 5, 6, 7 major so-called platform companies. If you look at the list of the 500 largest private companies in China, there are only about 5 or 6 that are these platform companies. The rest of these companies have not been affected by the regulatory crackdown. And I would go even further. Yes, Jack Ma lost, I don't know how much, several hundred billion in his portfolio. But the companies that are in that space are continuing to provide the services that help China grow. The online, the e-commerce, the ride-hailing, the delivery of food, and so forth and so on. The only sector that's really been crushed is the tutoring, online education, and that has really been crushed. But most of the rest of these platform companies, even though they've come under tighter control, are continuing to provide services to the economy that helps it grow. So I think the private sector hasn't been that much impacted by the regulatory crackdown. And one of the things I look at on a quarterly basis is how much of the investment in China is being undertaken by private companies. It's been running about 55, 56, 57% of all investment in China has been undertaken by private companies. And that has not gone down since the regulatory crackdown. So the idea that all these private entrepreneurs are fleeing China and they're not reinvesting because they're worried that they're going to get pulled into this net of state control, I don't think that universe is very large. Now maybe the numbers will change as we move through a few more quarters and private investment. So I don't think private entrepreneurs have been, on average, greatly discouraged by the regulatory crackdown. There are a lot of people that think we should have a regulatory crackdown in the U.S. on some of these big internet companies that vacuum up lots of data and invade privacy and have market power that maybe is detrimental to consumers. I think it's a complicated question.
Thank you. Tim, what's your perspective on that? Do you feel like people, like entrepreneurs, more than just the few platform companies, have been impacted by the regulatory crackdown and the approach the Chinese regulators have taken?
Well, let me focus sort of on a broad context, but focus on the foreign business community, because I'm chairman emeritus of AmCham in China, and sort of try to get the mood of the companies. In part because of the uncertainty. I mean, the way when we're doing business, it's uncertainty about what's going to happen. And so you have uncertainty about how China's policies will unfold. You have Xi Jinping, who has introduced the concept of common prosperity. And we're still trying to figure out what that is. I mean, a part of the rationale apparently for the regulatory crackdown is we have these people getting very rich, they're not paying enough attention to the party or the people, so let's level a few of them, and then let's teach a lesson to everybody else that they need to be looking at the broader impact of their businesses. But people don't really know where this is headed. You have the trade frictions between the U.S. that have created a lot of uncertainty. And you don't know whether there's going to be a tariff imposed on your product, or there might be some sanction on companies or individuals that you're doing business with. So uncertainty in that sense. And then the COVID crackdown has had a very, on top of everything else, it has had a very, at least split my time between Utah and Beijing. And so that means that in the last 2 years, I've been through quarantine now 5 times. I'm one of the world experts on Chinese quarantine, because there aren't very many people who have done that. But the thing to say about it is it's an extraordinarily time-consuming and uncertain process. It's very difficult for people even to get visas to travel. All the old visas were canceled. And they're very, very selective on who they give visas to, because they don't want to have, uncertain possibility of introducing COVID into the country. So what is COVID zero? It's basically the idea that let's have zero tolerance for COVID. If one of you in this room tests positive for COVID, then let's figure out everybody that was in this room and everybody that was in this building, and let's take them off to quarantine for 10 days and test everybody and monitor them. And it's no nonsense. I mean, if you were looking at the news about Shanghai over the last couple months, I was in Shanghai during that period. I spent $18,000 for a ticket from San Francisco to Shanghai, because that's how much the tickets were costing. I had to spend a week in San Francisco before I got on the plane to have several COVID tests and be monitored by the Chinese consulate. You arrive in Shanghai, you're taken to a centralized quarantine station where you don't know what the room is going to be like, but you're put into a small hotel room. You're not allowed to leave that room for 14 days. If you're married, your spouse is in a separate room for you. And then at the end of the 14 days, and I have to do this in Shanghai because they don't have direct flights going into Beijing now. At the end of the 14 days, you still have to go to another place and be monitored for another 7 days before you're allowed to go on to Beijing. Now, when I was leaving in quarantine this time, Shanghai was in lockdown. So we had to find a place that would even take me, and we had to find a driver with the right license to get on the street to take me to the new place. And then I was locked in my hotel room for a week. And then after that, the hotel was all in lockdown, so nobody in the hotel could leave. And after spending a month in that hotel, I got special permission to go to the airport, get on a plane, and fly back. So my 7-week trip, I saw nobody, and I spent about $50,000.
Well, Tim, we're glad you made it back.
Thank you. The point that I'm making is not very many people are in a position to do that. And so if you look at the impact that that's had on business and business certainty, a good friend, Jörg Wuttke, who is the president of the EU Chamber of Commerce, he said that in the last 2 years, under this COVID regime, about half of the Europeans in China have left. And his estimate is that between now and the end of the summer, another 50% of those left will leave. And we're seeing a lot of people in the American business community. I even see a friend in this room that was a longtime member of the business community and decided that this was not the sort of environment that he could have his family there anymore. People at the U.S. Embassy have been curtailing their missions because it's too uncertain a place. One of the reasons I didn't make it to Beijing was at the end of the 3rd week, I was supposed to get a green code on my Beijing health app saying that I could go. And so I was checked out of the hotel, I was sitting on my suitcase, and it didn't come. So I had to check back in the hotel and stay another 3 weeks. A friend of mine did get his green code, and then when he arrived in Beijing, he was put in quarantine for 2 more weeks. And so what's the impact on this? The impact is air traffic between the U.S. and China over the last year was down by 98%. It means that it's hard for companies to fill positions with expats or to go back and forth and conduct business. It means that there is more of an information bubble between the people in China who are trying to understand what their business should be doing and people back in headquarters that are hearing very different things about what's going on in China. We have a real disconnect between perceptions. In terms of supply chains, companies operating in China, it had a very devastating impact on a lot of their manufacturing sales. But even more than their China business, it had a big impact. So many companies rely on parts and components from China to run their factories in the United States. And so it was starting to have a real impact here. The point is, we may be through the worst of it, we don't know. But companies are not in a position to set up their businesses so that they have that level of uncertainty. And so this is likely to have a long-term impact. There are strategies for dealing with this. And believe me, I'm the first one that would be telling you, look at China as a possible outstanding and important business partner. But you've got to be a lot more thoughtful about how you do it now.
Thanks, Tim. And just a little context on that uncertainty there. For those who don't know, there's a for-profit tutoring sector in China. And so China decided that it was not in line with what they wanted for their social programs because it was apparently increasing inequalities because people were investing so much time in tutoring after school. And so very abruptly they decided that it was no longer legal to offer for-profit tutoring services to students between kindergarten and ninth grade. And so there was a handful of companies that almost overnight lost 85 to 90% of their market cap. So $30 billion for a subsector there that was just wiped away. And so I think that the abrupt impact of that definitely caught investor notice. And one foreign investor that invests in China told me it's just a reminder that China is still communist, right, in terms of their ability to come in and make very abrupt, strong regulatory interventions that have a huge impact on the economy. I want to shift a little bit away from that to one of the other big areas that's impacting the economy that China is working through right now. And so some of you who've been following the news over the last several months are aware that Evergrande, one of the largest Chinese property companies, has defaulted on debt and is symptomatic of a broader problem that China is facing in its property sector. And so some people are saying that they're on the cusp of a similar financial crisis that the United States went through in 2008, 2009, the Great Recession, the financial crisis. Zoe, do you want to talk a little bit about how the Chinese property sector and their investment-driven growth, which really is focused on property, housing, and infrastructure, and how that's impacting their growth?
Right, sure. Thank you for the question. So in many ways, a lot of there are a lot of discussions about to what extent this is going to be China's Lehman moment, where a wide range of property triggered entire financial market collapse. But in many ways, we haven't seen that coming. And part of the reason, I would say there are two reasons. First is because China's financial engineering is not as in-depth as the way Lehman was packaging it. And then secondly, it's also because, on top of that, it's also related to the fact that China's financial market in many ways is far from integrated with the rest of the world. In other words, less integration means less contagion, right? And then secondly, I would also add on top of that, is it related to that would be the in many ways, China already had a built-in way to sort of robustly support its failing companies, and in particular, government considered as systematically important financial companies. In particular, by this, I'm talking about state-owned commercial banks and state-owned commercial banks that have particular exposure to the real estate sectors, and that also involved provincial government-owned commercial banks or the so-called local government-owned special vehicles, right? So a lot of these collectively speaks to the fact that on the one hand, you are not entirely connected to the global financial sector, meaning you don't necessarily trigger a Lehman-style global financial crisis. And then secondly, because China already had a potential sort of a government bailout mechanism that basically said, eventually we are not necessarily going to let Evergrande infect the entire Chinese financial system. And one particular example that I can give you would be around in the early 2000s, there was China was facing the substantial domestic banking crisis. By a lot of measures, the 4 state-owned commercial banks was considered as insolvent because their non-performing loans was as high as more than 20%. So when that happened, the government realized, well, what are we going to do? Minister of Finance didn't have the money to bail it out, despite Minister of Finance back in those days were a major shareholder of the banks. So what they ended up doing was to use part of China's foreign exchange reserves to directly say, hey, how about we create this special purpose vehicle and use this special purpose vehicle to capitalize these banks and eventually help these banks go on IPO in Hong Kong, in Shanghai, and abroad. So in many ways, you have these built-in mechanisms to help or support. So I don't necessarily think in many ways how this would be or would have been a Lehman shock. And then, I guess the final remark would have, Damin Ma mentioned this in the morning related to the demographic challenges and changes in demographic challenges, and in particular changes in the, I would say, marriage market, not necessarily like a marriage market, but the lower marriage ratio among
We're
Chinese
very
people.
familiar with the marriage market here in Provo and Orem, Utah. So.
Right. I come from New York City, so we see different types of marriage market going on. So you do see a lot, declining in household making, household formation, meaning marriage. It has become a problem creating sustained demand for new houses, and in particular. But if we look down into which sector, in China, housing market is far from a unified market. I would describe it as housing markets, because there is not just the first tier, second tier, rural or a city. There is also the issue between new houses and old houses. And if you look at where the government crackdown on housing market, where the price decreased the most, it's not the new housing market, it's the old or existing market. So in other words, if the government policies is tilted towards not necessarily supporting the existing house, but supporting, or do not let somebody fall, but do not let the others fall, now you realize, oh, actually China could continue this borrow and build, hopefully grow going forward.
Thank you, Zoe. I think those are the very insightful comments, and on Evergrande especially, just in terms of how that may not end up being a contagion. Nick, along those lines there, on the demographic issue that Damien Ma spoke about, Zoe talked about, how much pause does that give you in terms of where the long-term growth rates go? Because I think you mentioned China will have room, under the right circumstances, right? If they make the right reforms to grow another 10 or 20 years, just looking at the growth trajectories of Taiwan or Korea or some of those other ones. One of the unique aspects of China, though, is the one-child policy and how that's kind of turned the demographics upside down, and then the fact that their workforce is shrinking and will be continue shrinking for a while. What does China need to do to combat that, and is that something that's going to be a real drag on growth going forward also?
Well, it certainly could be a drag on growth, but I think we also have to begin by recognizing that there are certain policy instruments that could be used to mitigate or partially mitigate the drag. Well, first of all, the real aging doesn't start for, I don't remember exactly, something another 5 or 10 years, something like that. Yeah, so the labor force is shrinking. Well, the first thing they should do is raise the retirement ages. We heard this morning, I think from Damien, with the 55 and 60. These ages were set back in the early 1950s when life expectancy was, I think, something like 44 years. So the average person never retired. Now China's life expectancy is roughly the same as you would find in Japan or the United States. So the life expectancy has gone up by more than 20 years, and they haven't done any adjustment on retirement ages. So if they want to increase the working age population, they need to raise the retirement age. They've talked about this several times. There have been a number of initiatives. The ministry in charge of this 4 or 5 years ago said they were going to roll out a plan. Of course, it met a lot of opposition. Think of the difficulties we've had in the United States of even raising the age for getting full Social Security benefits, by a year or two over a 5-year period. There's huge resistance, and this is not a democracy where people vote, but when people are very unhappy about a potential policy move, it has an impact on how they do. So I think this is something to keep in mind when you're thinking about the state and the party. I think too many people think, they just turn on a dime. If they want to do something, it gets done tomorrow afternoon at the latest. So that's number one. Mm-hmm. They have to raise the retirement age, and probably quite substantially, not all at once, but over a period of years to kind of ease into it. That will make a substantial difference. Secondly, and the most important thing, is productivity. The real source of growth in China is not more workers, it's been more output per worker. And as Mary Lovely mentioned this morning, productivity has actually declined quite a bit over the last 5 or 6 years. So part of it is the increased role of the state, the misallocation of capital, and so forth. If you can increase your workforce gradually by raising retirement ages and allocate resources more efficiently, so the return on assets goes up, your economy will grow better than in the absence of those things. So I think those are the two most important things to keep in mind. So I'm in the camp, I say, demography is not destiny. There are other things going on or might go on.
And I think that's where innovation plays a role, and I think that's where the open question is on China. With the increase of state influence, both with SOEs and the private sector and more state-directed investment, are they going to be able to sustain a level of innovation that will increase productivity in the long term? If they're not able to do that, then there will be some significant headwinds, I think. Tim, before we, just a couple questions, and then we're going to open it up to a Q&A. But Tim, what are you advising? You spoke about the uncertainty that zero COVID has brought, and I think zero COVID has had a significant impact that we're seeing here, just in terms of shortages, and it plays a part in inflation too, just because the supply chains get clogged up, the supply of products is reduced while demand remains high. Tim, there's a lot going on, especially, it was alluded to in the summit earlier today. Russia invading the Ukraine caused a lot of companies to think about what their policies were with regards to China and Taiwan that are doing business in China, how they need to think about it. What are you hearing, and what are you advising companies as they look at their supply chains and what they need to do in this new era?
Right. I think it's important to recognize that we are entering a new era, and we have U.S. China relations. Both countries have national security concerns about the others, and so that means that they want to control the technology that's transferred, and they want to have self-sufficiency on key technologies so that they can't be leveraged by a cutoff by the other country. And each country has things that they could use. China could cut off rare earths, or they could do a number of things that would create difficulties for us. So both countries are focused on national security. The U.S. has been focused on China's trade practices, which was the rationale for the trade conflict that we heard about earlier today during the Trump administration. But that introduced a lot of uncertainty and the possibility of tariffs. We're hearing that maybe some of those tariffs will be lifted soon, maybe not. But we're also hearing that USTR may launch a new 301 investigation, so there may be more products that would be potentially in the mix for added tariffs. So that's a thing. The US and China have different disagreements about ideology. And so, for example, we have coming into effect later this month the Uyghur Forced Labor Protection Act, which really puts a tremendous burden on anybody that tries to import into the United States anything that has any content from Xinjiang. And basically, if you have Xinjiang content in what you're importing, the burden of proof is on you to show that there was no forced labor that was used to produce that. And it's very, very difficult to figure out how to meet that standard. So our ideological differences, different views about human rights are a factor. So basically, any type of business decision that you make, you have to dig a little bit deeper and understand what are the policy trends in the United States and in China that could affect your decision. I have a very lengthy checklist that I use as I'm thinking about things, and of course I'm not going to run through the whole checklist, but if you think about the basic decisions you have to make as a business person, first of all, what products or services or technologies are you going to try to sell into the China market, or you're going to try to source out of the China market? There are regulations in both countries that could affect what's feasible or not, so you have to look at that. Secondly, who are you going to do business with? Are you going to have an equity partner? Who's going to be your supplier? Who's going to be your customers? There are different regulations in the United States and in China that could affect whether or not you're allowed to do that. And even if you're allowed to do it now, you may be concerned that given policy trends in Washington, or possible retribution by China if they see the U.S. do things they don't like, that could affect who you can do business with. Third, supply chain resiliency. The thing that's gotten companies so upset is the particular method that China is using to pursue zero COVID is so draconian that it can really cut off your business very quickly. And again, with the trade frictions and other things, do you have resiliency in your supply chain so that you don't have the potential of really having everything shut down because you don't get to move out of China or out of the U.S. Part or component that you mean? Third, human resources. I talked about the fact that a lot of expats are deciding that China's not where they want to live anymore. How does that affect who you're hiring, how you're running your businesses in China? So you have to think about where that's going. Managing conflicting regulatory requirements and public sentiments. You may do something in China. For example, I talked about the Uyghur Forced Labor Prevention Act. You have a responsibility, if you're going to import something, to track the supply chain to make sure you don't have things coming out of Xinjiang. But if you try to check with your first tier and second tier and third tier suppliers in China, you may have people say, you're part of this insidious American accusation that we're committing genocide, and there'll be a huge backlash against you in China. And so there's a company, I've also seen them at this conference, they did that, so then they apologized in China for implying that there was genocide, and so then they got a huge backlash in the United States. So you have to be able to manage the public relations and the conflicting regulatory requirements in both countries. Another area that's a very hot topic is data privacy and cybersecurity. Data, it was mentioned earlier today, data is seen as sort of almost like the oil of our generation. And so China's putting a lot of new requirements on whether or not you can transfer data back and forth. You may have to have a separate data regime for your business in China compared with in the States or in other parts of the world. And financial institutions are finding they may have to spend $100 million to duplicate their data service, and it also affects how they operate globally. So that's another thing to keep in mind. And then you just have a general environment where the regulators in China are being a lot stricter, and regulators in the United States are being a lot stricter too. So you really have to have a robust compliance problem. Now, or compliance program. Now, larger companies can invest in all these systems and all these internal functions and so on, and they're having to do it, and it's fairly expensive. If you're a smaller company and you're trying to keep track of all these things, it's very challenging. But those are the kinds of things that you have to be able to navigate if you're going to have a successful business between the U.S. and China these days.
Thanks, Tim. And I think challenging by design in terms of our new approach to China as we've reset that relationship over the last 5 or 6 years. And I think we talked a little bit about it before, and there's now this approach of China plus one. And so you're seeing companies start to shift away a little bit and start to develop capabilities and relationships in other countries. Aaron Starks in his panel talked about that earlier, whether it's Vietnam, whether it's Latin America, whether it's other areas, to be able to build out the capacity and relationships with those companies where you do not have to deal with these types of issues, and there are friendly relationships, easier ways to manage it. And so I think that's something that a lot of these multinational companies and organizations that advise them are taking, to take a look at some of these other areas, build out a contingency plan, build out capabilities and relationships now, so if you do have to shift because something happens, you have that capability there.
Can I add one more comment just on that? So China plus one is one of the buzzwords that we use in the American business community in China, or the foreign business community. Have an alternative so that if something happens to your plant or supply in China, it doesn't kill your business. And another buzzword is asset light plus optionality. That is, try to find a business plan for China. Again, this is what companies are doing to respond to the circumstance. Find a business plan that doesn't require an enormous contribution of capital. Figure out ways to leverage partnerships and other things in existing assets. Asset light plus optionality. Have scenario planning and build in different ways that the investments you've made there could be adjusted based on different scenarios that may unfold in the coming years. So these are some of the buzzwords that companies are using.
Thanks, Tim. All right, let's open it up for questions here. I think we have time for 1 or 2 questions. So I see a hand right there.
So, Dave Clayton, folks, I would modify the topic just a minute to say global disruption and risk. I may have missed this in the beginning. What about the South China Sea, Spratly Islands, and all that as far as a third of global maritime trade going through the South China Sea? What do any of you see about that and the risk that performs for global economy?
Zoe, do you want to take that one?
Sure, I'm happy to take on that one. I think yesterday morning, I think Ambassador Allen this morning put it very nicely. Every morning is a challenge to wake up, and yesterday I found it was a day like that for me. Right, I woke up reading the headline news came into my mind. It's like, oh wow, China has this secret navy plans in Cambodia. Right, in fact, I would say I would echo your point. South China Sea is a flashing point, and I would even say the fact that China has emerged as a major maritime commercial power, or commercial maritime power, not necessarily naval, but the commercial basis, that has become something that is from supply chain management, from how China might weaponize its control of global supply chains, how China might control or weaponize its dominance or control of 108 something port that China invested in. That is something we need to be concerned about. But I think your point is particularly correct in terms of South China Sea, because major Chinese oil flows, or LNG, not piped gas, but LNG, flow through South China Sea, right? And there, on top of that, you also now have the issue of Taiwan. Absolutely, I would add to China's domestic economy and global disruption risk, and I would add South China Sea on there, and also just to broaden that region up, there is also the Indo-Pacific economic framework. It almost feels to me like both the U.S. and China is trying to make promises, but the real problem is how the United States here, we can exercise or deliver a more credible geo-economic or geopolitical promises to our partners in the region. Now you see Chinese foreign ministers go to Solomon Island. Was that a surprise to many of us? Yes, it was, but should we be surprised? Perhaps the lesson learned is that we should not be, because we closed our embassy in the 90s. And how if we were no longer there, our president was not there, there was no alternative, right? So thank you for the question.
And I think in a lot of scenarios where tensions escalate to a higher level, particularly around Taiwan, as they game plan it out, start with disruptions in the maritime in that area. So I think it's an area that needs to be focused on. And I agree with Zoe that the United States needs to engage more aggressively with some of these countries where China is trying to set themselves up as the main ally and partner. Otherwise, there's going to be a vacuum that will be difficult for us to combat going forward. Let's one more question.
Well, let me add another word, R, Russia. Is that a risk for companies trying to do business in China now?
Tim, do you want to take that one?
So the Russian invasion of Ukraine has had some very significant impacts. So far, although rhetorically China has supported the Russian position in many ways, in ways that are sort of unsettling to Americans, they've also been very unsettling to the Europeans. The Europeans take this conflict very, very seriously, and whereas, as China looks at its needs for foreign technology and certain foreign products that they're not able to produce yet, they've been looking at Europe as a very significant counterweight to the United States, because the United States has sometimes, for example, Europe didn't have a trade conflict with China during the Trump administration the way the United States did. So they've been looking at that, but the way that China has reacted to the Ukraine conflict has really upset a lot of people in Europe. And Europe now says, gee, we didn't know China was really going to be this way, and what's going on in Ukraine is part of Europe, and we take it very personally. And so it's affecting the way the Europeans are dealing with China, and may make it that Europeans and China are looking at some issues more similarly than they have in the past. But having said that, so far, China seems to, it's always important in China to look at rhetoric and then to look at what the Chinese actually do, because they may feel compelled to say certain things because we've embarrassed them, or we've cornered them, or we've insulted them. So they may feel compelled to say certain things, but if you look at what they actually do, it's not so counter to what we would hope that they would do. And with respect to Russia, China has been pretty thoughtful about not violating U.S. sanctions. And so far, people have been talking about what would happen if they did. It just puts another risk on the list that we have to think about. But so far, it hasn't had a material impact on actual operations on the ground.
So if I could just quickly add one point to that, I would also highlight that Russia's invasion of Ukraine actually exposed the importance of ESG management or ESG governance for companies today, because companies are not just wanting to be profitable, but also good companies. And you also see this being expressed in Chinese companies as well, because this is the first time that a Chinese company like Didi being caught on both sides of the world. And I would echo Tim's point earlier. If you look at Didi's statement 2 days into the war, they made a public announcement to say, well, we are going to leave the Russian market. But then there's this domestic backlash to say why you are catering or yielding to, foreign pressure. Then what did Didi do? Didi said, well, okay, so we are going to stay. So it's just exposed a tremendous amount of this ESG risk as well.
Before we go, I think we're running out of time here, but one other area that presents a big risk going forward, particularly if China does grow its economy successfully at higher rates for a period of time, is the de-dollarization of the world. And so the United States derives tremendous benefits from being the reserve currency in the dollar. And so China has taken different measures to try to create a bloc through their BRI and different areas to create a block of countries that are not using dollars to denominate their transactions and their trade. And Zoe here has written a book on this. We're not going to have time to go into it in too much detail, but do you just want to plug your book for those of you who want to delve into this, which is an important issue that we need to be aware of from a United States perspective and a national security perspective?
That's very kind of you, Seth. So that the idea of de-dollarization, really, I have been looking into to what extent China and Russia, and in the context of BRIC countries, have been trying to promote an alternative, non-U.S., non-dollar-centered global financial system, because they have been talking about this since global financial crisis, right? So part of the study that I finished last year was to study what kind of non-dollar financial infrastructure that the two countries have been building. Now everybody is familiar with it, to what extent SWIFT is involved, China's SIPs, and Russia's SPFS, right? Everybody knows everything about that. But the one thing that I wanted to emphasize is that the strength of the dollar, at least in the medium to short to medium run, I think is there, because the treasuries market is the largest and the largest, most liquid asset market in the world. We talk about the treasury as the zero risk parameter when we evaluate the asset, and then on top of that, the attractive of dollar really is the U.S. economy. But that does not necessarily mean we should take the dollar's hegemonic power for granted, because if you look across history, sterling or even earlier the Dutch currency, none of those currencies or hegemonic currencies or dominant currencies had been persistent. So in other words, the de-dollarization infrastructure is there. The question becomes how the United States should react. Now, one important message that I think the Biden administration has been doing pretty well is to invest at home. And he has been also strengthening up institutions like DFC. So those are good remarks.
All right. Well, I'd just like to thank each and every one of our speakers here for their participation and coming. And I'd like to thank you for coming to this conference. So let's give a round of applause here. And I'm especially happy that everyone attended and is learning. Some of you are business people that are doing business in China, doing business globally. Some of you are here to learn. There's some students that are here. And our reaction to China and how we deal with China going forward is going to define the world for our children and our grandchildren, which is why a conference like this is so important. And I think we heard from Ambassador Huntsman, we heard from Matt Pottinger that the United States needs to take a more strategic, deliberate approach to how we're dealing with China and dealing with these challenges that arise. So thank you for your participation here.